Hello, in this video, we'll be going through impairments, the second part related to Goodwill specifically. So what is an impairment? When we purchase an intangible asset, the assumption is that the value we assign to it upon purchase will not go below the fair value of that asset. However, there are times when that does not happen and there can be a significant reduction to the benefits, to anticipated benefits or service potential of the asset. And that can arise from different reasons, and you can watch the first video on impairments if you want to go through all those different types of reasons why that can cause that. But when those situations arise, there is some accounting involved in what to do with that intangible asset. There are different rules of impairment, of what determines an impairment, how to calculate the impairment, depending on the type of asset. So if you have a property, plant, and equipment, which is also sometimes referred to as a fixed asset, and intangible assets with finite useful life, they have a certain accounting that's required, which was covered in Impairments Part 1. When we say finite useful life, it means there's a number assigned to the useful life of those assets, such as a patent usually can have a useful life of up to 20 years. A copyright has an assigned useful life that a company can amortize over. There are also intangible assets with indefinite useful lives, and such as trademark, trade names, and goodwill. And this is what we're talking about in this specific recording. Goodwill has an indefinite life, and that's because, first, just know that goodwill has to be acquired, be developed internally or created internally. And so goodwill is only recorded when there's an acquisition that occurs. And once that goodwill is recorded, and goodwill is when a company pays a price beyond the fair market value of the net assets that it has acquired. And that sits on your balance sheet as a long-term asset, but it does not get amortized. Why? Well, an indefinite asset does not have a useful life, and to amortize an asset over the benefit period that it will provide is impossible to do when there is no useful life assigned to that asset. So goodwill is capitalized, which means it goes on the balance sheet as a long-term asset and not subject to amortization. However, it is subject to an annual, at a minimum, an annual impairment analysis. So there are other indefinite intangibles that are also subject to impairment that's covered in the first video, but goodwill is a unique intangible asset because it cannot be directly associated with any sort of specific identifiable right, such as if you had a patent, then you know that this patent is for XYZ and its own kind of can be separately identified from everything else from the company. A goodwill is not separable from the company as a whole. So when we test for impairment for goodwill, we don't necessarily test the entire company. We have to test it at the reporting unit level. A reporting unit is an operating segment of a company or a component of an operating segment for which discrete financial information is available and the management regularly reviews those operating results. So these are, the reporting unit can be the segments that have financial information available. I want to quickly go, I pulled up the AT&T, the most recent AT&T 10K, and I went into the note 4 of their financials saying segment information. And it says our segments are comprised of, I'm not going to read this whole thing, but it goes on to say we have 2 reportable segments, communication, and Latin America. And so when you keep scrolling down, it gives you mobile communications here and Latin America right here. And it breaks down the revenues and the operating expenses and whatnot. And so they don't report, I looked and it doesn't report the book value, which is what you would need to calculate the impairment loss if there is one. But this tells us that the company has financial information on a segment by segment level and therefore would be able to do a goodwill impairment analysis. Let's go back to our presentation while it loads. Okay, now when we test for impairment testing for goodwill, the way we do it is we compare the value of the reporting unit, right? The value, meaning the fair market value, the fair value of the reporting unit, because that's the level of testing we do, with the book value. If the fair value is less than the book value, then you have an impairment. I'm just not going to write that out. But however, when you do that, it's not just the amount that the book value exceeds the fair value, and that's your loss. The loss can have a limit, and that is that the loss cannot exceed the book value of goodwill. Let's take through a very quick example to show what that means. Say you have a reporting unit where the book value of the reporting unit, including goodwill, and that's including, it has to include goodwill, is 1.2 million. The fair value of the reporting unit is 950,000. And so now we can see that the fair value is less than the book value by $250,000. You cannot take a loss of this impairment. You can't record an impairment for $250,000 because your goodwill is only $200,000. So your allowable impairment loss is only to the extent of the book value of your goodwill. So in this situation, you can only take an impairment loss for $200,000. Okay. So goodwill is done on a reporting unit, is tested on a reporting unit basis. So it's done on the reporting unit basis. But if there are other assets within that reporting unit, right, that can be separately identified, that need to be tested first for any impairments, such as the any sort of finite PP&E or finite intangibles, or even some indefinite intangibles that can be separately identified, like a copyright, like a trademark, then those assets need to be written down first. And then after that impairment loss is recorded, which would go against goodwill, then you would go to this kind of calculation for the whole reporting unit. And also note that once an impairment loss is recorded, it can never be reversed. So that's just something to keep in mind before any sort of goodwill impairment is recorded. Let's go through an example. In 2026, the Upjohn Corporation acquired Pharmacopoeia Corporation and recorded $100 million in goodwill related to this acquisition. After the acquisition, Pharmacopoeia continues to operate as a separate company and is considered a reporting unit. The following additional information is available at the end of 2027. Events and circumstances indicate that it's more likely than not that the fair value of Pharmacopoeia is less than the book value. And the fair value of Pharmacopoeia is estimated to be $360 million. And the book value of Pharmacopoeia's net assets is $440 million, including the $100 million in goodwill. Just want to highlight this one bullet point, that it is important when you're doing your analysis comparing your book value versus your fair value to calculate an impairment loss, the book value of the net assets must include the goodwill in that number. So let's calculate the impairment loss. We're told the fair value is $360 million. The book value is $440 million. So therefore, their fair value is less than the book value by $80 million. Okay, now we have to, and this $80 million is less than the $100 million that we have in goodwill. So therefore, we're going to record the entire $80 million. And what's that entry look like? We're going to debit loss on impairment of goodwill, which will be a separate line item on the income statement for $80 million, and we're going to credit goodwill for $80 million. Just want to note, so we started out with $100 million in goodwill, right? Now we're reducing it by 80. So the next year, when you're looking at your goodwill balance, you only have $20 million left in your goodwill. So if this is saying, so just to keep that in mind, that in year 2, when you're comparing your impairment loss to the total goodwill, it's the book value of goodwill. In year 2, the book value of goodwill is going to be $20 million.